Hello my fellow freedom builders and welcome back to the channel. Today we're going to have a look at the oil sector and something called value and dividend traps. The market is in free fall, as I am sure you know, and in these times it is very easy for new value and dividend investors to fall into some of the traps when the stocks are getting cheap. So we're going to have a look at that today. I'm going to give you a little overview of the oil sector again, and we are going to discuss some different companies. By the way, these times where everything is dropping, I am spending next to 18 hours per day in front of my screen, trading, investing, answering questions, making videos. So if you would like to subscribe to the channel and hit the like notification down there, I would be extremely pleased. Anyway, let's get to it. Right here, just to increase your pain level a little, I'll show you the Dow Jones Index. It is in free fall, and you might have heard the expression that the bull market is taking the stairs and the bear market is jumping out of the window. Jumping out of the window is what this looks like. It is an extreme move, and well, I'm happy that my different trend strategies got me out pretty quickly into the move, and therefore I'm missing out on all of this downturn here. But nobody knows how far we can go. But the market is dropping, but does that mean that the stocks are getting cheap? Well, let's have a look at it. First of all, if you are new to investing, then when we are talking about value investing, we are basically talking about that you're buying a stock that is producing some sort of profit. Let's say it was a stock that costed $1,000 and it produced a $100 profit. So that meant that you were getting a yield of 10%. You were earning $100 for your $1,000 investment. Now, if the stock all of a sudden dropped from $1,000 to $500 and you still got your $100 in profit, that meant that all of a sudden you would get 20% in yield, $100 out of $500, meaning that you were getting better value. And this money can come in when the stock is going up, or it can be paid out as dividends. So that is why we talk about value and dividend in this stock. But let's just zoom a bit out and have a look at the oil sector that I have chosen for today. Right now, and I mentioned it in my video the other day, right now there is two different crises going on in the world. There is, of course, the coronavirus, the entire issue with this illness from China spreading out to Europe, to United States. Entire countries are shutting down. And when it was first in China, it was a bit annoying here to us in the West, because it created a supply problem, because we could not get the merchandise we were ordering from China. But right now, China is slowly getting up to speed again. But now the entire world is shutting down due to the illness spreading, and that means that we are now seeing a demand problem. Because when it was only a supply problem, we could find new suppliers. It might take a little while, but we could get the production up and running again. But right now, the production is there, but there's no demand pretty much anywhere in the world. So that is the first crisis. Then the next crisis is we need these colored countries to explain that, because here we have, with the dark colors, we have the countries called the OPEC countries. That is the Organization of Petroleum Exporting Countries. And that is, of course, the countries, or at least the countries that in the beginning formed this, that were the largest oil and gas producers in the world. Then there is something called the OPEC Plus. That is the light blue colored countries here. We have Mexico, we have some African nation, we have Russia, we have Ukraine, and so on and so on. And that is kind of an organization, not as strong as the OPEC, but they have been working together. Now, When the OPEC Plus is producing a lot of oil, and they have been doing that for a lot of years, then if the price got a bit too high and the countries of the world ask OPEC, could you get the price a bit down, please? Then they started producing more oil. That would put a pressure downwards on the oil price. And we could see some cheaper gasoline for our cars. If the price got too low, then they stopped the production a bit and or reduced it a bit, and the price shot up. Now, the problem in the later years is that, for instance, in the United States, they have been producing a lot of oil and gas as well. They have been, the most successful part of it is from something called the shale oil and shale gas, coming with these fracking issues that you might have heard about. But they have been producing a lot of oil. And that means that they have been disrupting the entire oil industry a bit, or not a bit, but a lot. And that means that every time that OPEC or OPEC Plus have tried to get the prices up by reducing the amount of oil produced, well, then the United States have pretty much kept on producing or even increased their production. So they have kind of getting a free spin from the others' work. And it seems like Saudi Arabia and Russia are finally getting tired of that. So right now they are simply flooding the market with oil, the result of that, of course, is that the price is dropping. We can look at it here and see I'm looking at the WTI here. And you can see that right now the WTI is at just above $31, and it was only in January it was at more than double the price. So the problem here, of course, is that Saudi Arabia and Russia, they are producing the oil pretty cheaply, whereas the shale oil industry in United States, they have a production cost of around $48 to $50 per barrel. So that is kind of the base scenario, that right now we have the illness from China spreading, and that is really reducing the demand for transportation, for oil, for products. And that, of course, puts a pressure downwards on the oil price. And then we have Russia, Saudi Arabia, and some of the other OPEC countries flooding the market with oil, putting even more pressure downwards. And that is really, really hurting the oil industry in USA. So where should we go with this? Yes. Now the video here is about value and dividend traps. And the reason that I tell you this all again, I mentioned some of it in my video the other day, is that right now I get some questions about what I think about the oil industry, for instance, or the banking sector in the United States. Are they getting too cheap? Is it good value now? Should you buy? Well, normally when you're looking at a company, and let me just have a look here. I'm using Stockopedia here, my favorite tool. I'll link to it below here. You can see they have some very neat oversight, some values here. We can see that ExxonMobil, one of the really, really big producers of oil and a lot of stuff in that industry, they're using showing some pretty good quality, fairly good value, but not so good momentum, since everything pretty much is going down the drain for them. And if we're looking at the numbers, they're actually quite fair. PE ratio of 13, that is not terrible, and PEC ratio is quite okay. That's where we take the PE ratio and divide it by the estimated growth in earnings per share, and we can see the estimates are for some very good earnings per share here, and so on and so on. And we can see down here, if we are dividend investors, we can see that they are paying out a lot of dividends. They are actually paying out, we're getting 8% in dividend, and we should all be happy for that, right? Well, there are some problems. Already now we can see that in 2019 they had a very low dividend cover, meaning that they actually spent more on the dividends that they were making in the earnings per share. And you can also see in the free cash flow here at 1.25, and you can see they're paying out almost $3.50. So they're paying out way more than they have in free cash flow. Not a good sign. However, that's not really my point here. You could argue that you wanted to buy ExxonMobil because it's one of the big dinosaurs. They have been there forever. They have both upstream, midstream, and downstream pretty much in the oil industry. When we're talking about the oil industry, just for a quick notice here, we have these three different part of the oil industry. The upstream is the one that actually gets the oil up of the ground or from the bottom of the sea, and upstream industries are also the providers of oil rigs and all the equipment, the research facilities, finding the oil, and so on and so on. The midstream part is the one that actually that does the transportation. That is the pipelines, it is the oil tankers, and so on. Also a lot of storage capacity. And the downstream is that's pretty much the gas station. It is the media, it is the marketing, and so on for the end user here. So when we're looking at someone called ExxonMobil here, that is a huge company. You can see market cap of $157 billion. Well, then you could think that is a sure investment, and I'll just get my dividend. It is good value. They have been dropping too much. Let's get their let's just get their price up here. They are called ExxonMobil Corporation. As you can see, they are simply dropping out of the sky. And yeah, well, you can go back here, and it's not a pretty picture. If you have been in since 2014 here, it was up above $100. And now if you have been a buy and holder and going for the dividends, you would be down quite a lot. Of course, you would have gotten some dividend in the process. And if we're just looking at this is in the fast graph here. And we can see in 2014, we have that here. If you have been in from 2014 up until now, you would have lost 8% per year in the last 6 years. But that is because you have gotten a lot of dividend. Otherwise, you would have lost some more. But when we're looking at this, you could say, if you are a value investor and a dividend investor, you might say, now this is cheap. Now I'm getting an even better deal. It was just a month ago where I only had a dividend yield of maybe 4 or 5%, but now I'm getting more than 8%. And I know a lot of new dividend and value investors that fall in love with that dividend percentage. But what you should consider in a situation like this, where we are looking at a disruption of an entire industry, you should consider that when you are looking at the numbers that comes here, when you're looking at these numbers, you're looking at the past. So you're looking back and you're saying, well, they have been growing their earnings, they have been growing their dividends, they have been growing, and I like that, and they are paying the dividends, so it must be a fantastic investment. However, if something changes in an industry where maybe the stocks are getting cheap, but they're getting cheap for a reason, then that is what is called a value trap. Because if I buy a new car and I pay $50,000 for it and I drive it off a cliff, well, then I might try and sell it to my neighbor for $500. And he said, well, I know it's a new car. He just got it the other day. So $500, that must really be good value. Well, no, because it is cheap for a reason, because it cannot drive anymore. It is completely messed up, and it'll cost a fortune to fix it. So you should be aware that just because you are finding cheap stock doesn't mean that it is a good value. And for instance, in a scenario like this, where the entire oil sector is being disrupted, it is being disrupted by this illness that is causing a lot less demand in the world, and it is being disrupted by Russia, by OPEC, that is saying, well, we are fed up with the United States. They should not be making money on us reducing the oil output anymore. Well, then we are seeing a sector that maybe in the next quarters, maybe in the next fiscal years, are seeing a cut of 50 or 70, maybe 90% of their profits, maybe the profit will completely vanish. And my prediction is that we'll see some companies, and that could easily be in the oil sector, but it could also be in some of the other. We'll probably see S&P 500 companies that simply go broke, or at least need some massive bailout in the coming month due to the entire catastrophic situation in the world right now, where countries are shutting down, consumers are staying at home, and there's this price war going on with the oil. So what I'm urging you is that when you're looking at a stock, you should consider if that stock will in the future be affected severely by the current situation. A good example, for instance, could be if you remember, if you're old enough to remember this chain of stores called Blockbuster. That was in the days where we didn't have any streaming of videos, films and documentaries. So we went down to a Blockbuster store or something like that, and we rented a movie or 5 movies for the weekend or something like that. And Blockbuster was just a giant in this business. They were a chain of stores that people would swear they would never disappear. Well, of course, there's just this little thing that all of a sudden streaming became a thing, and Netflix came and so on, because we got fast internet, and all of a sudden an entire industry was disrupted. And what would have looked like some very good value if you had looked at Blockbuster and you saw, well, they were making money last year and the year before that and the year before that, but now they had dropped 80% in price. It must really be good value now. Well, it wasn't, because the industry was simply dying. So what I really want you to consider when you are buying, when you're looking at the dividend yield, is to consider how secure that dividend is. How certain am I on the value of this company? For instance, and I will make a new video about this tomorrow, I think, about what kind of companies I'm looking at. But for instance, pharma companies that are delivering good solid drugs to the consumers, and they have a patent running for a large number of years, and no matter if we face a large recession, then people will still need their insulin or whatever drug they are taking. Well, these kind of stocks, you could say, if they are dropping in price, they might actually be good value, and you might be getting a better dividend. So I'm not saying you should not buy right now. I'm saying that in the current situation, where the entire world pretty much is getting turned upside down, you should really consider where you're putting your money. And let's go back to the map here, because another sector many people are asking me is about the banking sector. Isn't that getting a bit too cheap, Hans? I'm getting some really good value signals here. Well, what you should consider is that the shale oil and shale gas industry in the United States, they are buried in debt. They have been borrowing so much money. It was a thing among politicians in the United States that US wanted to be, they wanted to cover their own oil consumption with their own production. And I completely understand why, because they didn't want to rely on quite unstable countries in the Middle East, for instance. So that is a completely fair argument. However, it was very expensive to set up this massive industry, and they borrowed the money. They borrowed them from different funds, from pension funds, from big hedge funds. A lot of in the financial industry have some huge lend out to this shale gas, shale oil industry. That means that if Saudi Arabia and Russia, if they succeed in bringing down this entire industry, then you will see a financial sector in real big trouble. Real big trouble. We are talking billions and billions and billions of dollars that have been lent out to these companies. I found a picture that said that just in the primary debt, they were owing the banks and the funds around $200 billion. and that a lot of that, something like between 40 and 60 billion dollars, should be refinanced here in 2020. But that they also have a lot of corporate bonds out, which actually has junk status. So it is junk bonds with a higher interest on, of course, but also a higher risk. And there should be significantly more than $200 billion buried there in debt as well. So if you see this single industry collapse, then you will see an entire underground of other industries in trouble as well. So I urge you to right now, in this situation that is pretty much the most serious financial situation that I have witnessed since 2008. As you might know, if you have heard me for a while, I've been investing since 1987. So I also just got started in the market before the big crash in 1987, where the Dow fell something like 25% in a day. That is before we had this circuit break that we have been triggered twice today to make sure that the algorithms are not running wild. But I was there in 1987. I was there in the Japanese crash in the 90s and Russian crash also in the 90s. I was there in that .com bubble. I was there in the financial crisis in 2008. And this is up in the same league. Let's just say it like that. It is hard to say if it will be as severe as 2008 or a little less or more. I'm not much of a fortune teller there, but it is severe. And what was the general rule and has been for the last 10 or 12 years of investing about just buy the dips and just find a company that is making good money and did that the year before and then buy it when it drops in price, just buy it cheaply. Well, it is still possible. And it is still possible to find sectors and good companies. And as I said, I'll take a look at that tomorrow as well. But just be aware that just buying because something is cheap and because a company made money last year, that can be a terrible trap to walk into, because there will be some shifts in entire industries where you will see companies go bankrupt, maybe that you had never thought of the possibility before of them going bankrupt. So I know it maybe sound a bit dark and a bit pessimistic, but as I said, I have a lot of years of experience, and this is one of the top 5 most dire situation I have witnessed so far. Fortunately, I am very much in cash, and I am also looking for which companies would like to buy, and I will inform you about some of them. I'm also day trading a lot. I have some money in these algorithms that are running, so I'm actually making okay money. So I'm not so worried about myself. I'm worried about the entire system, and we will see some collapses of maybe small countries, actually, of governments, of large companies that could have a widespread effects. So all I'm saying is the same that I always end my videos with is take care of your money out there. Don't fall into the trap, especially if you're a new investor. Please sit tight with your money and consider it really, really deep before you're putting your money into something right now. That said, we are probably also past at least most of the downturn in the market. Let's just have a look at where it stands right now. We have here, we have the Dow. We can also have a look at the S&P here, which is dropping quite wildly. But from a top to a bottom right now, we are... The worst case here was 26%. So if we're saying that 20% is an official bear market, then we are just about there right now. And if we're going back in time, we are now, if you have been buying and holding, we are at the same point as in September 17. So had you bought the SPY ETF back in September 17 and held it up until now, you would be in break even. So that said, these 26% at the crash in 2008, when we had the worst day at all. When we were farthest down in the big hole, we were down something around 55%, I think, from the top to the bottom. But the year ended, quote unquote, only in around, I think it was 34% down, something like that. Meaning that it actually took a good upturn from the bottom. And as you might remember, if you were there in February, March 09, it really turned, and we had something like 10 or 12 years of good bull market after that. So if you are a long-term investor, if you are looking at a time span of more than 5 years, of 10 years, 20 years, 30 years, then it might be a good time to start considering what stocks should I buy right now, because there is really some possibilities of some good value out there. What I'm saying is, take care of your money and don't fall into the trap of thinking that a cheap stock equals a value stock, because it doesn't. And the sectors you thought were safe, they might not be safe anymore. So do a very good research job, do your due diligence, and of course come back to this channel. I'll tell you my view on the entire market and on the stocks you could look for and what tools to use and so on. And you're always welcome with comments and with questions. I'll do my best to answer them as quickly as possible. That's pretty much all for now, guys. As I said, I'll be back tomorrow with some sectors and some specific stocks that I am actually looking into myself. But as I said, take care of your money out there. Remember to subscribe to the channel if you like the content here. That would be very much appreciated. All right, thanks for now. I'll talk to you again tomorrow. Have a nice time out there. Bye.